So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we'll be. We didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks bounced back on Friday, with Wall Street notching weekly and monthly wins as investors embrace strong earnings from Amazon that ease some doubts about the prospect for big tech, especially as it pertains to the AI trade. You can see right here, consumer cyclicals, the XLY on the back of Amazon and Tesla rallying were up 9% and 3% respectively. This really helped the AI trade. You could see some of the infrastructure names booming. Software names were also up right here. Meta fell another 2%. That really helped big tech go lower. But the rest of communication service was pretty bullish, and Google flat here after a stellar week for Google itself. Nvidia was flat, Microsoft was down on the back of its earnings as well, and then AVGO down 1.82%. And all in all, it was kind of a mixed day through and through. A winning week, don't get me wrong, a lot of volatility, but Friday as it is, there were winners, there were losers, with the S&P 500 up 0.33%, as you can see right here. Now, most sectors did gain, with the XLY really being the rising tide that lifted all boats, up 2.64%. The XLRE was also green ever so slightly, but on the precipice here, and everything else was in between, with gold down 0.54%. XLU, XLB down in the mix as well. Staples and healthcare. And really what we saw was defensive sectors, staples, utilities, healthcare were red. Sensitive sectors, rate sensitive sectors were really good. Cyclical sectors as well were very, very green. We actually did see small caps and mid caps perform as well, particularly in the growth area. And in fact, we generally just did see outperformance in value core growth on the small cap and mid cap sides, but large caps performed too. And it was a green day through and through here on Friday. And a lot of this momentum came off big tech, but also came off some of the China-US trade deal. Now, President Trump over the weekend announced that they had a deal or a trade truce here with China. Now, there's a lot. The documents for this was very, very big, but highlighting some of the key points. China will suspend all retaliatory tariffs and non-tariff measures imposed since March 4th. China issues a new general license for rare earth exports and pauses new export controls. China commits to end fentanyl flow into the US. China will buy at least 12 million metric tons of US soybeans, and the US will cut Chinese goods by 10%. So they'll reduce the tariffs by 10%. Seems like a great deal for the US. This is the biggest de-escalation in US-China relations since the trade war began, and I think the market is really going to latch onto this and find some confidence in this. This is really good. This is a really good deal for the US. And at the same time, we actually did see big tech stocks help the tech sector, and ultimately that's what drove market momentum today. Amazon, like we said, was up 9% 9.58%, closing at all-time highs after its third quarter results easily topped the analyst forecast. In particular, its cloud division, AWS, posted a 20% jump in revenue, signaling renewed strength in enterprise demand. Netflix was also up 2.74% today after announcing a 10-for-1 stock split. And then we also had a couple of earnings movers here. ExxonMobil and Chevron reported earnings. Mixed price action, but both reported earnings beats. Exxon reported an earnings beat. Chevron reported an earnings beat. And Chevron's beat was actually quite big thanks to the Hess acquisition, which boosted oil production. And despite falling oil prices during the quarter, the super majors, these two companies, increased production quite significantly, and that is why they were able to beat their earnings estimates. And then for everything we saw today, there was 2,800 decliners, 3,500 advances. We saw net inflows, or I should say outflows, in the New York Stock Exchange and the Nasdaq 100. S&P 500 gained ever so slightly. And look, market momentum not looking that great. The shorter term and medium term averages not looking that great. In fact, well below the 50% mark, but the longer term average is looking really, really good. And ultimately, this is what matters here. So long term are looking good. Shorter term, expect volatility, but we'll see what this renewed trade news brings us. Now, looking at the day that was, you can see it was green through and through, with the RSP mid-cap and the Russell 2000 outperforming, but we saw strength through and through in the entire market. Now, looking internationally, it was really just the US that rallied. Middle Eastern stocks rallied, and we actually saw the rest of the international markets fall. Crypto was actually kind of flat. You could see it down on Sunday, up on Saturday, net flat here for the weekend, but they did actually perform pretty well on Friday. Volatility was up. The 2-year and 10-year yield was actually down. The dollar did gain. Treasuries fell. Gold and silver fell. Now, the month of October is officially up. This is the monthly chart right here for the S&P 500, up 2.27%. So very solid month. And you can see this monthly chart looks incredibly bullish. We simply got higher highs, higher lows into a monthly closing all-time high. This is absolutely bullish. And even though we did see a little bit of volatility towards the end of the month there, still a bullish month in October. Very, very good stuff. Diving into the weekly chart, as you can see right here, the weekly chart, we just notched a weekly all-time high for the S&P 500 as well. However, this is a very ominous looking candle. That's called a shooting star doji. Oftentimes, this is a great reversal indicator. Will we get that? We'll see. We'll see. I think a lot of the volatility that we did see this week came off uncertainty, and we do have a lot of that certainty now with that trade deal. That being said, you guys know that if we do get an extended pullback in the market, we are looking for an opportunity to buy here at the 6130. That would be about a 10% pullback if we actually measure peak to trough, and then we are looking for us to go higher into 2026. I think this will be a great place to reset right here, but this momentum is just absolutely strong. And you could see that dips, like when bought, we get dips and they're very shallow, and the market just scoops them up and we just travel higher. So if we do get a dip, it's very likely it's going to be a shallow dip, and then we continue higher to the 7,000 area here for the S&P 500. That being said, a dip to 6130, that would be a strong buying opportunity. For the Nasdaq 100, that opportunity, right, will be the 22,000 level. The reason why I like these levels is because where we used it as resistance previously before the tariff news, the tariff tantrum, and then we actually broke above it and rallied. So if we do get to this 22,000 level or the 6130 level, onward and upward from there. For the Russell 2000, it's right here at the 2,400 level. The Russell 2000 on the weekly chart actually breaking out, guys. This is actually all-time highs for the Russell 2000. The RSP, very similar situation. You could see we're pretty much here at these all-time highs, notching intra-month, intra-week all-time highs. And again, a pullback to the 180. You should see it go from there. For European stocks, they look really good. Look at this weekly chart, right? Again, if we pull back to the 555 area, buy those dips. And that is ultimately the story of this market. We have very clear momentum, which is bullish. And so ultimately, we want to be buyers of dips. We don't want to be taking shorts. We're still in a rate cutting regime. We likely are going to get a rate cut, if not December, January, early 2026, we definitely will be getting a rate cut. Earnings are beating expectations. Things are looking really good right now for the market. And ultimately, you just want to be buyers of dips in this market, even in these crypto assets. I think if you look at the weekly chart of Bitcoin, I mean, this is just like higher highs, higher lows into all-time highs, which we made just as quickly as 3 weeks ago. If you hop on the daily chart, things look a little bit less certain. You can see here that we've pretty much traded sideways for the last 3 or so months. us. But as long as we hold this key 103 area, I remain constructively bullish on Bitcoin and just crypto as a whole. Ethereum as well, we're in this falling wedge pattern, but as long as we hold this wedge pattern, I do think we go higher. And ultimately all crypto is doing is digesting a massive move off the tariff tantrum lows. I mean, if you actually take a measured move right here, peak to trough, guys, it's 134% just for Ethereum. If you zoom out even more, you're looking at close to like 250% here for Ethereum. Absolutely insane when you look at it in aggregate. Now, some names I do like with regards to that is BMNR. You guys know this. I've been talking about this name for a while. I really like holding BMNR at this level right here. It was up 4.71% on Friday. I do think sometime in 2026, we're going to clear some of these highs, right? And possibly even reach these all-time highs sooner rather than later. This is a long-term hold and a long-term bet on Ethereum, the exact same way MicroStrategy is. And I am bullish on Strategy, but what we are seeing is a bit of this NAV premium implode here for Strategy, which is good long term, which is not good in the short term, but it can be, which ultimately isn't good. But I guess the market is repricing with all of these like ETFs that they have, for example, STRK, the perpetual preferreds that MicroStrategy is releasing. Essentially, the market is again repricing those market activities. But ultimately, I do like both of these, BMNR and MicroStrategy. I also do like a lot of these AI names. You guys know this. I've been speaking about it for a while. APLD. If we can get to the 30 level, buy those dips. I really do like this name. I do like CoreWeave. NBIS, you guys know this. I like all of these neo clouds. I think you want to lean into infrastructure and AI infrastructure because the mega caps told us this past week that they're going to increase spending into 2025 and 2026. And these are going to be the biggest beneficiaries. Iron, NBIS, CoreWeave, all of these names are going to be good. And power is the bottleneck. If you guys want great power plays, EOSE is one of them. Really, really strong momentum right here. Great premiums. It's just selling puts, selling calls as well. Plug Power is another one. Now, this one I think is inside the buy zone, which is right here at this 250 area. From there, I think we can go ahead and hit that $4.59 again sometime soon. But I like all of these names. I like all of these plays, these AI infrastructure plays, the power plays. I think there's still a lot of room in this rally for these names to go higher into the end of the year, into 2026. Now, guys, diving into sentiment, this is BOFA's bull bear indicator, which edged up a tenth to 6.3, its latest reading, which remains closer to a contrarian sell than a buy. However, roughly in the middle, you would sort of call this neutral, I guess. Technicals are very bullish except for high frequency trading positioning, which is bearish, and then long only positioning, which is neutral. So this indicator does still have room to run if it wants to get really, really frothy, but we are getting a little bit frothy. That being said, seasonality does point to us going higher, and November seasonality is quite bullish. We tend to see rallies, consolidations, and then an end of month rally. November tends to be very, very bullish, upward of about 3.5% for the year in the S&P 500. So guys, don't bet against the market in the month of November. And the truth of the matter is earnings is spectacular. Guys, look at this. This was the estimates coming into earnings season, 8.6% here for Q3. We're reporting 13.8% and 14.7% if you exclude the energy sector, led by tech, real estate, industrials, materials, financials, a lot of the broad market. I mean, tech is in there, but a lot of the broad market participating in this earnings move. Absolutely insane. 83% of companies reporting above the analyst expectation. And this is what is going to take us higher along with the macro. And this is very interesting. BOFA left their third quarter GDP tracker at 2.8% as of Thursday, with the only update CPI, which impacts the deflator since it is a real number, which was not enough to move the needle. As a reminder, they were 0.8 low for Q2 GDP. In other words, if they come in again, you could potentially see a GDP number closer to 3% here. Very interesting stuff. And the economy continues to grow. Inflation continues to cool. The labor market, was seeing a lot of mixed stuff, but we do get labor market data this week. Now, tomorrow, We're getting the ISM manufacturing numbers. So this is ultimately what's going to move the market, guys. But earnings is probably going to be the biggest mover apart from if we do get the non-farms data at the end of the week. But earnings is going to move the market. We have Palantir and HIMS tomorrow. So do be aware of that. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, leave a comment for the algorithm. Cheers.